On May 16th, 2025, something happened that had never happened before in the 116-year history of Moody's ratings. The agency that had assigned the United States of America its AAA sovereign credit rating since 1949, through World War II, through the Korean War, through the Vietnam War, through the oil shocks of the 1970s, through the savings and loan crisis, through the dot-com crash, through the 2008 financial catastrophe, through a global pandemic that shut down the world economy, removed that rating for the first time. The United States lost its last AAA, not its first, its last. Standard & Poor's had stripped the first AAA in August 2011. Fitch removed the second in August 2023. And now Moody's, the final holdout among the three major rating agencies, the one that had maintained its AAA on American government debt through every crisis of the modern era, officially concluded that the trajectory of American fiscal policy had reached a point that could no longer be characterized as the highest possible credit quality. What I want to show you today is not what most financial media covered in the hours after the downgrade. Most coverage focused on the immediate market reaction, which was muted, and used that muted reaction to conclude that the downgrade did not matter. That conclusion is the most expensive analytical mistake an investor can make right now, and I want to explain precisely why. I have spent 40 years studying how sovereign credit events interact with monetary history, and what I know from that study is that the significance of a credit rating action is almost never visible in the immediate market reaction. The market that prices the daily moves in stocks and bonds is the short-term price. The market that prices the structural trajectory of a monetary system is the long-term price. And those two prices can diverge for months or years before the structural price forces the short-term price to catch up. In 2011, when Standard & Poor's stripped the United States of its first AAA, the immediate reaction was counterintuitive. Treasury yields fell. The dollar strengthened. The short-term market, flooded with capital-fleeing equity volatility, bought more of the asset that had just been downgraded. An analyst watching only the immediate reaction would have concluded that the downgrade was irrelevant. An analyst watching what happened to gold over the following decade would have reached a very different conclusion. Gold rose from approximately $1,000 per ounce at the time of the S&P downgrade to its subsequent highs, driven in part by the structural realization that the American fiscal trajectory that prompted that downgrade had not been corrected. It had been allowed to compound. The Moody's downgrade of 2025 is not the beginning of a new story. It is the confirmation that the story that began in 2011 has reached a new chapter. And the arithmetic behind that chapter is more severe than anything that existed when Standard & Poor's first raised the flag. Let me give you the specific numbers because this story is in the numbers, not in the rating symbolism. Moody's downgrade cited one primary driver: the growth in American government debt and the rising cost of financing it. At the time of the S&P downgrade in 2011, the United States national debt was approximately $14.3 trillion. Today, it stands at $36.2 trillion. In the 14 years between those two events, the debt more than doubled. The interest payments on that debt have gone from approximately $250 billion annually to $1.03 trillion annually, crossing for the first time in American history the threshold where interest payments alone exceed the entire defense budget. Moody's projects that if current fiscal trajectories continue without fundamental policy change, the federal debt burden will swell to 134% of GDP by 2035, up from 98% today. To put that number in context, the United States never exceeded 120% of GDP even at the height of World War II, when the country was financing the largest military mobilization in human history. We are on a trajectory to exceed the debt levels of World War II, not because of an existential military conflict, but because of the accumulated weight of fiscal decisions that every successive administration and every successive Congress has declined to address. Moody's language was precise and unambiguous. Successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs. That sentence is not a commentary on a temporary problem. It is a description of a structural failure that has compounded through administrations of both parties across more than a decade, and that Moody's has concluded shows no credible path toward resolution under current policy frameworks. Now, I want to explain the specific mechanism by which the loss of the final AAA rating interacts with the gold market, because this is the connection that most financial media fails to make clearly. The AAA rating is not merely a symbol. It is a functional designation that determines how certain categories of institutional capital must be allocated. Pension funds, insurance companies, sovereign wealth funds, and certain categories of institutional investors operate under regulatory frameworks and investment mandates that specify minimum credit quality requirements for their portfolio holdings. U.S. Treasury bonds, as long as they carried a AAA rating from all three major agencies, met the highest possible threshold for these mandates. Every institutional investor that operated under a AAA requirement could hold treasuries without question, without exception, and without the need to justify the holding to regulators or trustees. The Moody's downgrade means that U.S. Treasury bonds now carry a AA+ rating from every major rating agency simultaneously for the first time in history. They are no longer AAA by any reckoning. For the overwhelming majority of institutional investors, this creates no immediate obligation to sell. Their mandates typically require investment grade ratings, not AAA specifically, and AA+ is well within investment grade. But for the subset of institutions that operate under the most restrictive credit quality mandates, and for the algorithmic systems that automatically adjust portfolio weightings based on credit rating changes, the Moody's downgrade creates a structural marginal pressure on demand for Treasury bonds that did not exist the day before May 16, 2025. Marginal pressure on Treasury demand means marginal upward pressure on Treasury yields. Marginal upward pressure on yields at a moment when the United States is refinancing $9.2 trillion in debt this fiscal year at rates already costing $1.03 trillion annually, means the debt arithmetic becomes more difficult, not less. And a debt arithmetic that becomes more difficult is one that makes the eventual resolution through monetary debasement more likely, not less. Gold prices debt debasement before the debasement is announced. That is what gold does. That is what it has done in every monetary system in recorded history. And the Moody's downgrade is the most explicit official confirmation yet that the conditions for debt debasement are not theoretical. They are structural, documented, and accelerating. I want to walk you through the three previous American credit rating events and what happened to gold in the months and years that followed, because the pattern is the most important data I can give you for understanding what the Moody's downgrade means for the structural gold thesis. The first event was Standard & Poor's downgrade in August 2011. Gold was trading near $1,600 per ounce at the time of the downgrade. Over the following 2 months, gold surged to its then record high of approximately $1,920 per ounce. The short-term market reaction to the downgrade was a flight to Treasury bonds, which drove yields down. But the structural market reaction was a flight to the asset that had no counterparty risk, no credit rating, no sovereign issuer whose fiscal management could be questioned: gold. The second event was the European credit crisis of 2011 to 2012, which followed the S&P downgrade and confirmed for global investors that the post-2008 monetary environment had permanently changed the relationship between sovereign creditworthiness and the assets investors trusted to preserve purchasing power. Gold held its gains through that period and set the foundation for the structural bull market that has continued with interruptions through the present. The third event was the Fitch downgrade of August 2023. Gold was trading near $1,900 per ounce at the time. Within 6 months, gold had surged through $2,000 for the first time in history, and then continued to new all-time highs throughout 2024 and 2025, driven by the same structural forces that Fitch had identified and that Moody's has now confirmed with its own downgrade. Each rating action was called irrelevant by the financial press in the immediate aftermath. Each rating action proved to be a structural marker on the path of a gold bull market that has been pricing the fiscal trajectory that the rating agencies were documenting. Now, let me address the argument that is always made when a credit rating action proves muted in its immediate market impact. The argument is that the United States is different, that the dollar's reserve currency status insulates American government debt from the consequences that would follow a similar rating action for any other sovereign, that investors have nowhere else to go, that treasuries are still the world's safest asset by any practical measure. This argument contains a truth and obscures a more important truth simultaneously. The contained truth is that U.S. Treasury bonds remain the largest, most liquid, most institutionally embedded sovereign debt market in the world. No alternative exists that can absorb the capital flows that treasuries currently handle. The dollar's reserve currency status is real, and it is not ending next quarter. The more important truth that this argument obscures is that the dollar's reserve currency status and the AAA rating of American government debt are not the same thing. The dollar maintained its reserve currency status when S&P stripped the first AAA in 2011. It maintained its reserve currency status when Fitch stripped the second AAA in 2023. And it will maintain its reserve currency status now that Moody's has stripped the third. What changes with each downgrade is not the dollar's reserve currency status. What changes is the accumulated weight of official acknowledgement that the fiscal trajectory supporting that reserve currency status is unsustainable. Every downgrade is a data point in a structural argument. The argument is not that the dollar will collapse tomorrow. The argument is that the conditions for eventual monetary debasement are accumulating faster than the political system is capable of addressing them. And gold, which has no credit rating to lose, no fiscal deficit to disclose, no debt to refinance, and no politician whose decisions determine its value, prices that accumulated weight in its structural price over time, not in the week of the downgrade, over the years that follow. Moody's projected that interest payments on federal debt are on track to consume 30% of government revenues by 2035. At that level, 30 cents of every dollar the federal government collects in taxes goes directly to servicing existing debt before a single dollar is spent on defense, on healthcare, on infrastructure, on education, or on any program that a citizen could point to and say, this is what my taxes pay for. 30% of revenue consumed by interest alone. That is not a projection about a distant crisis. That is a projection about a fiscal structure that is already in motion, that is already producing the interest burden that Moody's documented, and that is already constraining the Federal Reserve's ability to raise rates in response to inflation without simultaneously triggering a fiscal crisis that would require the monetary response that gold is already pricing. The two indicators I watch most closely following the Moody's downgrade are the same two I have watched through every credit event in my career. The 30-year Treasury yield, which briefly traded above 5% in the days following the downgrade, a level that the debt arithmetic I have described makes increasingly difficult to sustain without forcing a policy response. And the gold to currency ratio in the reserve portfolios of the world's central banks, which has been shifting systematically toward gold for 3 consecutive years at double the historical average pace. Those two indicators tell you more about the structural trajectory of American fiscal credibility than any single credit rating action. But the Moody's downgrade tells you something those indicators cannot. It tells you that the 3 institutions whose job it is to assess sovereign creditworthiness officially and publicly, the 3 institutions that every pension fund, every insurance company, and every sovereign wealth fund is legally required to consult before allocating capital to government bonds. have now unanimously concluded that American fiscal management no longer merits the highest possible credit designation. That unanimous conclusion did not exist before May 16th, 2025. It exists now. And in 40 years of watching how sovereign credit events interact with the long-term price of gold, I have never seen that conclusion, once reached, prove to be temporary. The rating agencies do not upgrade the United States back to AAA without a fundamental change in the fiscal trajectory. And the fiscal trajectory, as Moody's documented, has been moving in one direction for more than a decade without interruption. Most investors dismiss the downgrade as symbolic. The investors who understand what the symbol is actually measuring are not dismissing anything. Now you understand what they understand.